All right, so before you trade another 0 DTE iron condor, ask yourself this question. Is it right for you? So in this video, I'm going to dig a little deeper as far as iron condors go, more specifically to 0 DTE iron condors, and see, is it really right for you? Because a lot of people, they go into thinking, hey, this is what I want to make, because they might be attracted to the fast churnover. They might be attracted to the fast theta, but it may not be right for you. So we're going to answer some of these questions. Now, if you're brand new here, I'm Sasha, the options coach. Been coaching people the last 10 years in options trading. And we recently did an Iron Condor deep dive class. Now, in this video, I want to share with you a little insight as far as trading Iron Condors and looking at, are they right for you? Because a lot of people, they go in and they start getting attracted to all of these things, but it may not be the right fit. Anyways, if you're interested in this class, just check out our website, optionsblackbelt.com. All right, so let's get started with the first main thing. And the first thing is that when we're looking at it, you might not be able to watch the market intraday. When you've got a 0-day iron condor, what happens is you have an extreme speed when it comes to that theta decay, okay? When you have that speed, okay, you have a thing called gamma risk. What is gamma risk? Gamma risk is known as price risk. See, a lot of people, they have seen this picture where you have, let's say, 30 days on the option premium. Okay, so, and it starts decaying. So you've got this 30-day concept, and then you go down to 0 days. So here we go, 0 day, 30 day, and then the premium dollar value. Okay, so they've seen this picture, but what they haven't seen is the inverse of this, where what you've got is you've got the price risk behind it. So when you go into a 0-day trade, what's happening is that price risk is so accelerated that it's known as gamma risk. And that gamma risk gets faster and faster with the shorter the duration. When you're doing short duration, you know, you've got to really watch that market. You got to watch that individual ticker. And when it may not be as peaceful, you see, now what you're going to do is you're going to concentrate some risk in that spot, and you got to watch it, instead of maybe going into a handful of other trades that could be a lot more peaceful, more relaxed, and you could actually go out and do stuff throughout the day. All right, so that's kind of the first thing. The second thing that you might want to think about is that you don't handle stress or pressure well. When you're doing things like these iron condors, and especially you've got 0 day, let's say you've got this iron condor here where I'm risking maybe $1,000 to maybe make $100. You know, something like this. Now, what happens, you might start it out neutral, and then what it does is it slowly grinds up on you, slowly keeps grinding up on you. You're like, oh my God, I still got 4 more hours in this market. You know, what am I going to do? So as you keep grinding up on this, it starts to become a little bit more pressure-like, and you're like, man, I'm starting to freak out and stress out. You have to do trades where you're comfortable, because if you're constantly dealing in this pain of you know, stress, I mean, it's going to be nuts. It's going to be crazy, and you're going to be overwhelmed. You're going to get stopped out of the trades that you shouldn't be stopped out of. It's not beneficial, and you're going to be losing more trades than you're winning, because the fear is going to stop you out all the time. So watch out if you can't handle stress or the pressure, because the 0 DTE is starting to kill you and put more pressure on you. Then maybe 0 DTE iron condors are not for you. There might be other 0 DTE trades like an at the money vertical for you. We did kind of a class on at the money verticals not too long ago. I called it the 50-50 coin flip strategy. But the point is that, you know, these trades are a little bit more peaceful in some cases when it comes to these 0-day trades. For some people, again, you're trying to find the right fit. Not everybody is going to be the right fit. It's just the same way that when you are here, okay, and then you're trying to make friends with people, not everybody's going to be your friend, right? You've got maybe a handful of different people, and they're not all going to be your friend, right? So some might be bam, bam, but these may not be. So, and that's okay. And the same thing with trading, the strategies, it's got to be the right fit. So when you make a connection here, okay, you might make a connection with a handful of people, and you might make a handful of connections with a few different strategies, but they're not all the right fit. And the same thing with those 0 DTE irons, that if you can't handle the stress, it's not the right fit. Okay, third thing, let's take a look at sizing too big. If you size big, if you size large, what's going to happen is you're going to put too much capital in one spot. 0 days, you know, they can move quickly on you, and you usually will not size them all in one spot. Now, I've done coaching for quite a long time, and I've seen a lot of different accounts. Some accounts, you know, very small accounts, and I've seen some accounts in the $60, $80 million range, even more beyond that. But what I will tell you is it's not that I haven't seen large accounts trade shorter duration, because I have seen a few where they do only 0 DTE trades. I've seen some hedge funds where they do 0 DTE trades. That's not the issue. They manage their risk, their tail end risk, and so on. But what I will say is there's not a lot of traders that I've seen 0 DTE trades that, you know, that don't know what they're doing and then they size huge. So what I mean by this is that, okay, if I wasn't clear, we don't just take $20 million and put it into a 0 DTE trade and hope for the best kind of thing, okay? Normally, if you're doing $20 million, okay, you're going to go and spread it out every 10 seconds you might be putting on a trade. So you're doing 0 DTE, and now you're aggregating risk across different iron condors throughout time. You'll probably also do other expirations as well, but let's just say for a minute you wanted to do 0 DTE. You're not going to position them all in one spot. So as price is moving and wiggling, you've got a lot of different iron condors putting on. I've got one guy that you know, uses a hit timer, you know, like a workout trainer timer, where every 10 seconds, 20 seconds, he's putting on a trade, putting on a trade, putting on a trade. It's not always iron condors, but my point is that we aggregate risk then across the day instead of all in one spot. And when you deal with larger size accounts, we need to spread that risk. So if you're sizing too big, you're putting it all in one spot, that's a problem. So think about this. If you're scaling larger and larger and larger, a lot of times you don't always see that with larger accounts, putting it all in 0 DTE. I'm not saying you can't. I'm not saying you can't do it. I've seen it done before. But it's just the mentality and the shift, the way that it's done is much different than what most people think at the retail level. It's not like, hey, I'm putting on $20,000 in 1 minute, in 1 second. We're going to spread that $20,000 across the next 2 hours at different strikes, different zones, different areas. Anyways, think about that. That's a whole deeper discussion than what I can handle here in this YouTube video, but I think you get the point and concept. Okay. Anyways, that's number 3. Let's take a look at number 4. You expect to win pretty much every single trade. So a lot of people that do 0 DT, because the way that it works and the way that it behaves, just the sheer nature of the probability of success. Okay, what happens is that when you have a trade where you're winning, let's say 60 to 90% of those trades, well, you're constantly expecting to win. And then when that loss comes, it becomes a problem. So if you're always thinking about like, hey, I want to win every single trade, that's going to trick you psychologically, where you're going to get used to the habit of winning. And then when the loss comes out, the fear, the emotions are going to creep up, and that can be a huge issue and problem. So be very careful in here. In fact, sometimes I like putting on tiny bite-sized pieces of other sided type of trades, and that, you know, show me that I'm going to lose. Maybe they're not as favorable, and sometimes they win out fine. But what I do like to do is sometimes the inverse types of trades, meaning they're not as favorable. Maybe instead of selling an iron condor, I will actually go out and also buy iron condors, where sometimes those trades are losing trades. Okay, when we look at these, they are maybe losing when the iron condors, the other ones down here where we're selling them, we are winning, but these we are losing. But that way it keeps your mental game in check. Whereas this one, you might do like 1 contract. Okay, but over here you might be doing 3 contracts. So you're still winning and panning out. But in some cases, the prices do move quickly, and this can help alleviate some pressure. Anyway, my point is that if you expect to win every single trade, it can mentally get you conditioned to doing and always seeing that you're going to win. And that can be a huge issue. You can create moments of euphoria. You have to be disciplined, calm yourself down, and not get too emotionally riled up, right? Be careful, be mindful. Okay, number 5, last one, is that you might prefer a long-term investing approach. There's nothing wrong with that. Some people like, hey, just setting and forgetting, crockpot method. If that's the method you like, that's okay. Some people prefer, hey, people who are tall. Some people prefer people who are short. Some people prefer people with long hair, short hair. You know, I mean, you got all kinds of different, you know, personality traits when you're looking for a relationship. So it's the same thing when it comes to trading. 0 DTE iron condors may not be your thing. There's other 0 DTE trades. There's butterfly trades. There's also at the money vertical trades. There's just selling credit spreads. There's just, so you could just be selling puts 0 DTE as well. I mean, there's just so many different ways that you could do 0 DTE trades. You might even not be the 0 DTE person. You might be a 3 DTE person. You might be a 5 DTE person. So you can still do shorter duration trades in those. And in fact, if you didn't know, you could do 0 DTE trades doing a 30-day trade, right? Meaning you are in the trade in and out in one day or less than a day, but you're holding like a 30-day trade. One of the things that I like to do that with is at the money verticals, calendars. They're low in commissions. Sometimes these calendar trades, you might be able to get out in 1 or 2 days or within a day, depending on market conditions, of course. And you might be able to make a little bit of change. It's not, huge, because if you're doing like a 30-day, you might not be able to get out as much. But if you're putting on, let's say, a $300 trade, you might be able to get out for $320 and making $20, which is roughly about, let's call it a 8% return on $300. Again, you won't be able to size it too big because then the market will shift on you. But the point is you'll be able to do still longer duration trades, but still do them short duration to churn and rotate the capital. Anyways, so those are kind of the things you want to think about as you go in and see, doing iron condors, doing even calendars and other things. Before you're doing those 0 DTE trades, ask yourself that question. Is it right for you? Is it the right fit, right? Some people like running. Some people like hockey. Some people like tennis. What sport is right for you? What trading strategy? What trading duration? How do you manage it? What is right for you? And it's going to be different for everybody. It's going to be fine-tuned. Yes, there's some foundational things. Yes, there's some basic concepts to making things work in your favor, but you have to kind of align those pieces. Okay, I like this for entries. I like this for management. And I like this for exiting. And I like this for handling risk when it goes against me. So there's a lot of things that you're matching up to making things work. So anyways, I hope you found that helpful, gives you a little insight. Check out our website if you're interested in some of the courses and classes that we've got going on, workshops. I mean, you name it. We've got a lot of stuff there for training, and, hope to see you in one of them. Make it a good one. Enjoy, and I will see you on the next one. Take care.